Hey everyone, today in this video I want to go over a method of trading options where over time you'll consistently be profitable, and on top of that you don't need any knowledge about the underlying company, and I personally believe it'll be better if you don't have any assumptions on the company either. First, as a disclaimer, I just want to say I'm not a financial advisor, so please do your own due diligence before investing. Most people trade companies by buying the underlying stock and hoping the stock price rises, but in reality, can we be certain that the price will rise? Can we be certain that we will make money? Just look at General Electric, for example. We have seen a massive bull run. Ever since then, it has been on a steady decline. I want to teach you another method of trading that's called selling option premium. Note, selling the options, not buying them. Selling option premium has a much higher chance of success. When you sell a call option, you want the stock to stay below your strike price. And when you sell a put option, you want the stock to stay above your strike price. If you want to know exactly what a call or a put option is, I made a video on that, and I'll link that in the description box below. And you want the stock price to stay in between the strike price of your call and put. There are many different kind of strategies that you can do by incorporating different calls and puts. One that I like to use the most is called a strangle, where you sell an out of money put option and an out of money call option. An out of money put option is a put option that is below the stock price, and of course an out of money call option is a call option that is above the stock price. And of course, you want the stock price to stay in between the strike prices of your call and your put option. I like to think of this like you're an insurance company. You're selling insurance to someone else, but the risk in insurance is always overstated. That's where your edge is. By selling that insurance or premium, we can profit on that extra risk that's being overstated, and therefore over time will consistently be profitable. The reason why I like this method of trading is that I don't need to know anything about the underlying company, because you assume everything is priced to perfection. If there is more risk in the company, there will always be more premium to make up for it. Therefore, the more risk there is, the more profit there is to be made. Another reason why I like this method of trading is that you can defend your trade without increasing the size of your position by either rolling your untested side up or down to collect more premium, or roll them out to collect more premium. I'll go over that in an example very soon so you have a clear understanding of what I mean. But when you purchase a stock and it goes against you, you either add more shares and increase your position to bring your cost average down, or you close it for a loss. And I hate closing trades for a loss. So for this example, the stock IWM was trading at around 135, and say I sold the 140 call option and the 125 put option that expires in October, and I collected around $200 in premium. Note the red and green lines that you see will represent the call and the put option strike prices, and the length of the line will represent when the option expires. These weren't the exact strikes I sold. I rounded the numbers off so it'll be a little easier to follow. So we want the stock to stay within the 125 to 140 range in October so it expires worthless. But let's say the stock has moved up to around 140, which it did. You would then roll the untested side, the 125 put option up. How much you roll up would depend on how bullish or bearish you are. But let's say we roll up to the 135 put option and collected around another $100 in premium. So now we want the stock to stay between the 135 to 140 range, and we have collected a total premium of $300. That's called rolling the untested side up. The 140 call option is a tested side because the stock is going against that position and testing that side. Another way we can defend the trade is by rolling options out from October to November. The current options expires in October, but say we extend that time frame from October to November. Since we're extending that time frame of the insurance, we can collect more premium. Say the stock IWM is trading around 140 and we still aren't profitable yet. We can roll the options out to November and say we collect another $100 in premium. So now in total we collected $400 in premium, and we just keep doing this until the trade is profitable. And while the whole time we're doing this, we have not increased the size of our position. Even though we were wrong on the direction of the trade, we can still make money. Like I said, this was a real trade of mine, and IBM kept moving up. When I closed the trade, IBM was at 160, but I was profitable. Even though the stock has moved $25 against me, I was still profitable. All because of the premium I've collected throughout the trade. This is just one of the few times where I had to really defend my position. Majority of the trades are profitable without any adjustments required. So just to prove my point, comment below with a stock you like me to trade, as long as the options are liquid, and preferably no stocks trading around $1,000 or higher. I like to trade naked options, and I'll provide an update on the trade in a future video. And as always, if you enjoyed the video, please like and share the video. It really helps out the channel. If you haven't subscribed yet, please make sure to smash the subscribe button. And thank you for watching. I'll see you guys in the next video.